Hello and welcome to the Financial Time Travelers podcast. This is episode 10. Excuse me, sir. Your bias is showing.
It's what?
Part 1.
Part 1.
Part 1. One for winners.
A lot of this.
Yes.
That's good music.
Solid.
Who wrote this?
When you break it down on piano, it really takes a whole new emotional toll on your
Sounds
body,
good.
your mind, and your soul.
We should give credit to whoever wrote that great lead-in song.
Yeah, that's
It was you, wasn't it?
That's me. That's your
Very
good old
nice.
boy.
Yeah.
So today we're going to be speaking on something that we feel makes you feel some sort of way about how you receive information and how you lie to yourself.
Yes.
You don't know it, but your mind is deceiving you when you make decisions in the stock market. Specifically, when you're investing, there are ways that we digest information, and sometimes if you're not aware of what's working in these environments, it might take this information and skew it.
Right.
Perhaps like looking at a mirror that's bent, and what
Right.
you're seeing is a reflection of something that actually isn't there.
Yep. And what we're talking about here is, of course, investing.
Sorry, I was being
But-
very ambiguous there.
Very ubiquitous. However, as you were saying that very ambiguous statement,
There you go.
I was thinking that it actually applies in a lot of areas of our lives. How we kind of convince ourselves to come to a conclusion. People like us, people don't like us. He said what, she did what. And we come to conclusions, sometimes even with all the data in front of us, and we somewhat just kind of ignore it. Our mind messes with our mind, right?
This is especially true. They teach a lot of, or can I give it away? We're talking about logical fallacies. We're
Right.
talking about cognitive biases. Today,
Yep.
we're specifically going to be talking about cognitive biases. Now, in part 2, we'll talk about emotional biases. Can you let
Right.
the listener know what differentiates a cognitive bias from an emotional bias?
Yes, and specifically, these two episodes are going to be critical to increasing your success rate of being in investing, because wealthy people consistently make more money, consistently outperform the amateurs, and just like in the Texas Hold'em World Championships, consistently the same 10, 12 people are at the final table, because there's a process that they go through that consistently produces success.
Before you answer my question,
Okay, which I was just
professional
about getting
dancer
there.
over here. We'll get
Yeah.
into ballroom dance, maybe some salsa.
Yeah.
Is that when you first go to the gym, right?
Right.
And your mile is a 12-minute mile. It's easy to cut, or like golf, for instance, when your strokes you're in the hundreds, or really any physically demanding or mentally demanding sport achievement
you wanna
that you're
make
trying
improvements?
to achieve,
Is that
where
what
you
you're
want to
talking-
make an improvement,
Okay, all right.
and you start cutting off. Like, it's really easy to figure out, okay, these are big things I can cut off,
Right.
or even losing weight, or adding weight. At the beginning, it's easy to make huge improvements, but really at the end, like if your mile's 10 minutes, it's easy to get down to 8 minutes, but
Right.
then getting from 8 to 7
Right.
is way more difficult.
And 6.5.
Right. So today we're not trying to get you into a 5-minute mile from a
Right.
6-minute mile. We're trying to get you down to 8-minute mile from a
Right.
10-minute mile. So if you can start applying this knowledge, it will help you differentiate from the pack immediately.
Right. No, that's very good. Very good.
So what is the difference between a cognitive bias and an emotional bias?
Okay, so we're gonna, and this can be a two-part.
You're dancing again.
Yeah. And
I need
so the
answers.
emotional is going to be very exciting. So we want to encourage you to listen, because actually
Exciting
the emotional
emotionally or physically?
the emotional bias that we make decisions, and mostly bad ones, about what type of investments. But the cognitive is the falsehoods. A cognitive bias, somewhat like falsehood under disguise that presents itself as truth when it really is not. And you want to ask yourself, now, why would a fact that's been given to me that I know is true, and then I don't follow it or don't
Right.
believe it's true? Why would that just sounds ridiculous. Why would you do that?
Right. I take information, and the way that I digest it and then act on it is
Right.
different than what it actually is.
Right.
It's almost like when you put on your sunglasses,
Right.
you're now seeing the world in a different shade, but the world is still the same shade that it was, whether you take the sunglasses on or off. And so we're trying to remove those lenses off your eyes so you see the practicality and how to execute it when you're making investment decisions.
That's right. And so just to digress for a second here.
Let's do it.
But as we learn and talk about how the majority, the populace of people make decisions, One step more advanced than that is managing based on the premise you know what most people are going to do. So that's going a little bit deeper. First, we're going to figure out what you're doing, what most people are doing wrong in a cognitive and then an emotional bias, what's preventing them from making good decisions. Then we're going to go one step further, and we're going to talk about how you can make money based on the fact that you know how people are going to make decisions.
Without succumbing to the overconfidence bias.
Right. We won't. Yeah.
So it's very particular. Hold on. I wanted to outline the difference between this episode and the next one.
Okay.
So emotional bias is how you feel when you interpret information, and that affects how you make decisions.
Yep. It's
Cognitive bias is how you digest information through a distorted perspective.
Right.
And so we're going to take away the distortion and give you just the true sound. Like if you're playing on a guitar, we got to take the distortion pedal off. I'm killing it with the metaphors today. You got to take the distortion pedal off and just hear that true sound coming off the body of a hot Fender Stratocaster.
Well, you can go even more pure with an acoustic.
Oh.
Yeah. So the point that we're getting to here is all of this is titled in universities and colleges called behavior economics. So it's studying the behavior of people, regardless of the data, regardless of the facts, they're studying how do people react and what is their behavior, and then how does it apply to the returns that they make, behavior economics. So that's what we're going to talk about. Behavioral. Yes. So we're going to break it into two categories. Cognitive is today's topic, and we're going to go through some of the mistakes, some of the aspects of the bias and what they do and the results of those bias. And what we're talking about is the process that you and your brain go through together, go through together as data is coming to you, and then you come out with a false decision which leads to losses. So today we're going to try and unpack that and get to some real learning.
This is relatively new. So biases that affect the market. So if you have a bias in you that you're affecting into the market, then that would imply that there are inefficiencies in the market.
Right.
That the market isn't 100% efficient.
Yes, that's a good point.
The forefathers of economic theory, which is a social science, first instilled into us back in the 50s when they rolled out the ticker tape and the efficient market hypothesis and the guys at the University of Chicago.
So let's define the listeners what you're talking about. So the efficient market hypothesis is what?
Is that the market is operating as efficient as possible. Everything is priced exactly as it should be. All information is immediately reflected in the prices of an asset or security.
And what's interesting with that, Nyle, is that you would think in high-frequency trading, there is any piece of data that you want to know around the world instantly, right? And with today's internet, instantly. So one would think that the market is absolutely properly priced second by second.
Correct.
Therefore, there would be no way for there to be a bubble.
Exactly.
Right? And which a bubble is an inflated price above intrinsic value. So let's say Apple is worth $90 a share and it's trading at $110. How did they get to that premium pricing? So you would think efficient market hypothesis or theory would be even more in place today than it was in the 1950s, and yet it's worse.
Right. Well, it's a very interesting topic, and that's why things like behavioral economics are starting to come out as a new form of understanding why the market moves the way that it does. And the original economic founders, and this you'll start to see behavioral economics introduced through government with the Department of Regulation going into retirement plans. So we're seeing auto rebalancing, automatic contribution rate increases, automatic or qualified default investment accounts, default investment accounts. These are all attributes of behavioral economics that have been introduced to the working world to try and get people to save more and earn more so that they're better prepared at retirement. But at the same time, the original economic statisticians labeled us as the Homo economicus, which is the being that constantly makes rational decisions. They're always optimizing their choice. They're always going to choose the optimal choice for them, and that's not always the case. We saw that Richard Thaler noted that when Obama came out and said, we are going to open the trade embargo with Cuba, there was a mutual fund with the ticker symbol CUBA that had nothing to do with Cuba, that traded at a 70% premium that day. Now, that was all because of a cognitive bias. So let's get into the very first cognitive bias. Enough of this dilly-dally, fluffy. I don't want to hear it. I'm steeping my tea. Actually, it's mate. It's not tea.
Yeah, yeah. So there's 5 derivatives that we're going to break, or versions
I'm so
of
corny.
cognitive bias that we're going to talk about, and how you as a listener can listen to this and think about, does this apply to me? Is some of the things that I think about?
I don't think
and then
it
how
does.
can I learn? So the first one is the confirmation bias. And I think this is the biggest one that I think has the biggest impact. And when we watch the news, we have monitors in our office and playing CNBC, and we're constantly watching. And it's interesting. Right. I could have the sound off, and without knowing what the market's doing today, just by watching the people, I can tell you if the market's up or down today. And almost just by the guess. If the guests are predominantly bullish or positive guests, it's an up day. If they're predominantly bullish or doom and gloomers, it's a down day. And so this confirmation bias is somewhat you're being led to come to a conclusion even without even thinking. So the confirmation bias, you're drawn to information that validates your belief or opinion. So you have a thought, you have an opinion, you like this company.
Right.
And now what are you going to read, Nyle?
Now, the media has keyed in on this. They perfected the confirmation bias. They want to understand what the reader wants so we can deliver them the message that they want to read.
They want the reader to buy the paper or subscribe or whatever.
Now, occasionally they might have, the contrarian view to stir up controversy, and controversy wins.
Right.
But the confirmation bias, yes.
Right.
If I am bullish on the market, I'm going to read bullish sentiment.
Right.
If I am negative, I'm going to read documentation that would show that I am right.
Correct.
Because everybody loves to be right.
Right. And if you're conservative, you're going to read conservative sources. If you're liberal, you're going to read liberal. So one of the things that I have done for a long, long time, a particular policy that I have personally, is I subscribe specifically to multifaceted, multi-opinionated sources. So the Economist is predominantly a liberal type magazine versus Forbes, versus Barron's, versus Wall Street Journal. And so I purposely, Newsweek, Business Week, I read for sources for 2 different objectives. The first objective is I want to get an understanding of what's being told to the people.
How dumb they are.
Right. But specifically, what is being told to people? Because I want to monitor what I think people are going to do.
That's fair.
Then the second thing is that I want to see how much of a separation there is between the 2 opinions. When the separation is greater, the volatility is higher. When they're more in sync, there's less volatility.
Right.
So I want to pay attention of what is the liberal media saying, what is the conservative media saying, so I can sort of pay attention to it.
What are those crazy progressives thinking?
Yeah. But the question that the listener might be thinking is, okay, he listens and reads liberal and he listens and reads conservative. How does he know what is true? And my opinion and experience is that news and media is worth what you pay for it. So if you're paying $100 a year for an annual subscription, it's worth about $100. But if you want true advice, you're going to be paying real money. And that can get very, very expensive. But you need to get outside of that noise because everybody else is just trying to sell a newspaper or a subscription, whatever.
I don't know if that's an almighty rule because it sounds like a false equivalence.
Yeah, and actually you don't. So actually, to be candid with you, know the truth is irrelevant because even if I find out that the truth that the market, let's say for example, is 10% overvalued, it's true. That it is 10% overvalued. It doesn't matter because if the behavior economics, the behavior of people are believing that it's undervalued and the market keeps going up. A great example is during the 1990s, I had some battles with portfolio managers in which I didn't really care what the market was priced properly. I didn't care if a .com company with 30 employees had no earnings. The stock was going up, so I owned it.
Right.
So I was totally focused on the behavior aspects, what is called the momentum type of investing. I didn't care what about the company.
And that was looking at the technical charts and saying,
Totally.
hey, there's a buying opportunity here. I don't care what the fundamentals say. The market's taking off, and I'm going to enjoy the fruits of the economy's labor right now.
Right. And so the confirmation bias tremendously worked in my favor. We did extremely well for ourselves and for our clients because we were just going with what everybody believed. But as soon as it turned, we were out. And that saved our butt because in 2000, we started selling and we were out of the market.
You were educated,
right.
which leads us...
But I didn't get sucked into this confirmation bias that it's all true and I knew it was all false. Now, when we move on to the next one, which is a great one, Nyle, and this is one we were talking about earlier, is the gambler's fallacy. So talk about that.
So the gambler's fallacy, and sorry, I wanted to pull up a couple tweets because I see this on Twitter all day long. But the gambler's fallacy is the cliche, if you flip a coin 30 times, or heads or tails, you should have a 50-50 chance on, whoa, a little bit of feedback from our module there. But if you had a 50-50 chance of landing heads or tails, right? There's no reason why it would land tails or heads more often. So if you flipped it 100 times, then that would say that
on 101.
Correct. So if you flipped, sorry, the little market, this thing is interface is freaking out on us.
Okay.
All right. So if you flipped a coin, heads or tails, 100 times, in the first 50 times it landed heads, then the gambler's fallacy would say, okay, it's due for a tails,
big time
on the next.
You can bet
flip.
all your money.
I'm gonna go all in, because it's landed heads 50 times, without thinking that each individual flip has its own variables and its own air and wind,
there's some connectivity between each of those flips, and that if you flip it 5 times and it's always head, the 6th time the odds are growing bigger and bigger and bigger that it's going to flip on the other side. And so with the gambler's fallacy, why we call it a fallacy is that the nickel doesn't know that it flipped 10 times on heads. It does, and when you flip it on number 11, has no idea that
doesn't care.
It's inanimate, doesn't know you, doesn't exist, doesn't have any emotion. The chance of it flipping heads or tails is exactly the same on the 100th time as it was in the first time.
Right. Here's a great one. Last time the S&P 500 was down 2% on Friday and bounced back greater than 1% the next Monday, August 2007 and April 2000 before that. Could happen today.
Yep.
So it's saying that based on previous events that had entirely different market conditions, today should act just like them.
Yeah.
And now so it's feeding upon that fallacy that we believe that the market is going to act identically to other periods of time, even though that we have completely different variables. And in science, that would be what we call unsound science, where you're taking 2 different experiments with completely different variables and comparing them against each other, or what the laymen like to call apples to oranges.
Now here I will take a little debate with you on this. I'll take the opposite side, where I don't necessarily believe that the gambler's fallacy is completely out of consideration when it comes to people and the investment marketplace.
Because you're a salesman.
Because the nickel is inanimate. It doesn't have any impact. It doesn't know. But the stock market, people are reading the same newspaper, reading the same AP articles, Associated Press. And so there is going to be a reaction that is somewhat predictable. If on Friday of this last week, the market was down almost 400 points, that's 2 whole days that people are going to read nothing but bad news. So that leads to Monday. So there's going to be 2 different types of emotions. One is I need to get out, and number 2, this is a buying opportunity.
So I guess the mortgage derivative collapse would be the stake in your theory that would say, no, sir. Because as they continue to decline and people were missing their payments, a gambler's fallacy would say, wow, I've never seen this kind of decline. It's going to bounce back stronger. And what happened? Lehman Brothers went out of business. We needed injection into the economy to stabilize. And that's why there are many times that we could show that the gambler's fallacy is not a crutch that I would want to lean on when making investment decisions about my future.
So there is a little nuances here. The confirmation bias is pretty straightforward. With the gambler's fallacy, one needs to determine how much human interaction, human involvement is involved in this statistics. For example, the 1% fluctuation in the market, lack thereof, leads to that there's going to be a big fluctuation. So there's a little involvement here looking at how information is being conveyed to the investing marketplace and how the people are going to react.
And I think Twitter in particular is a great place for false equivalence or a gambler's fallacy, because you don't, for a technician, he could have some valid points in there, but he only has 140 characters to do it, which is not enough. And so it's easy for me to take that and say, hey, that's a little too much. So let's move on.
One last point, though, that I wanted to make is that in my world, when a particular statistic or phenomenon is in place, and the more it's well known, the chance that it'll be accurate. So when you talk about the market hasn't fluctuated more than 1% for the last 40 days, which is an experience we just completed. And now the market has fluctuated more than 1% 2 days in a row, 2 consecutive days.
Right.
But the more a particular nuance or type of an event has taken place, most likely the further the opposite or the expected action is going to take place.
I don't know what you're saying.
So what I'm saying is that if everybody knows that if the market hasn't fluctuated 1% for the last 40 days, the chances of a major fluctuation is imminent. The more people know about it, the longer that imminent is.
It's not
imminent. It could be weeks, it could be months away because more people know about it, so they're paying attention to it. So what are they doing? Is the opposite. They're actually self-fulfilling this event to continue on.
Just because the market's in a tight trading.
Well, the reference, the inference
is not
is
imminent.
that it was going to, there's a big correction or a big rally imminent because the market's been so stagnant for 40 days. And then what they do is they go back to periods of time that were 40 days of stagnation. What happened at the end of those 40 days?
We're talking about fallacies, and you're saying they're correct.
No, what I'm saying is that the fallacy is that if this happens, then that will happen. It doesn't work out that easy.
Oh, okay. I get you now. I'm
Right.
sorry. But at first I was thinking, I was like, what? You're saying the opposite.
No, and the more that people know about a particular nuance or occurrence, the more people that know about it, the less likely it's dependable because the reactions are all different.
Yeah, because it starts to get levelized.
So when you take the last, let's say, 5 periods in a row in the last 20 years, the market was stagnant at 1% volatility or less over 40 days, and then took what happened on day 41 and then came to the conclusion that the market's going to go up because most times at the end of a 40-day stagnant period, the market goes up. You could be wrong because guess what? Everybody's reading the exact same information that at the end of 40 days, the market goes up.
What would be more intuitive would to research why the market is going to go up or down.
Right.
Not just it's going to because of past trends, but because these are the actual variables that are occurring in the market that are moving it. So moving on, we could do a whole podcast on gambler's fallacy. You're very, a lot of experience here, and so it's hard to narrow it down sometimes into a short period of time because we have so much experience to provide for the listeners who subscribe at financialtimetraveler.com, who see us on the social media channels, who tolerate our shameless plugs. So as we move on, the status quo bias, I just kind of leaned into it, we want to be up there in the status quo at financialtimetravelers.com. So the status quo bias is another one that I see a lot, and it goes into, let's say, the S&P 500, where we have some specific leaders that are constantly at the top, Apple being the largest, most profitable company in the history of the world. So I want Apple. Another one, let's say I like Tesla. All my friends drive a Tesla. I want to own Tesla stock.
Priceline.
Our boy Nick over here loves some Nike SB, you know, so he's like, let me get some Nike stock. Is this a status quo bias that's coming into play?
Yeah, so
Sorry, Nick, I love you.
buying companies that are well-known, and they're well-known because they're constantly being promoted in the papers, talked about in the papers, and so because of that familiarity, they become the status quo.
And what do you get to do at cocktail parties?
Yeah, talk about what you just bought or that you own.
Talk about it.
Yeah, I just bought Apple, or I own Apple, and it was up 2% today like it was, and you're pretty happy.
And the guy with the Lord Abbott Strategic Income Fund is like, oh, I got nothing cool to talk about.
Yeah, exactly. So status quo, buying what is acceptable or comfortable, and that's going to be a lead into our next segment, section 2 on this episode number 11, is how the status quo plays into an emotional aspect that almost can assure you you're going to lose money every time, but that's a little lead in.
We'll
for our
save
next
that for
one.
part 2.
So the next one is a bandwagon effect. Again, sort of like the status quo, bandwagon is jumping on momentum investing, which you can make money. And I talked about this in the 90s. I jumped on the bandwagon. Shamelessly, I was buying stocks that had no value, no earnings, no profits, and stocks were going up. I'm totally jumping on the bandwagon.
Yeah, but you were more objective.
Right. But I was doing it for the money. But, you know, there's some, in our economy.
Now we do it for the gram.
Now, our cycle.
We do it for the vine.
Yeah, we're doing it for the profits. But recently, there's been we're in this stagnant cycle, and we talk about this in other podcasts and in our members section of our website about how there are growth cycles that tend to be 17 years, and then stagnant cycles which also tend to be 17 years. And how you jump on bandwagons and growth cycles is entirely different how you jump on bandwagons and stagnant cycles. So a couple examples in a stagnant cycle, it's false starts all the time. And the most recent one that listeners might remember is 3D printing. I mean, they were all over. All you read about in the last couple of years is 3D printing.
Ticker symbol DDD.
That's one of them, yes. And so those companies had a lot of cachet. It was very exciting, the idea that you could be printing your auto parts in your garage. You could be printing candy in your home. And the stock just went nuts. And then it ran out of momentum, and now it's down about 80% since that top. So momentum in stagnant cycles, you want to be very short play. Long-term momentum plays in growth cycles are outstanding. Those companies are on the front page. They keep killing it. They're doing good. But bandwagon momentum investing leads to bubbles, and you have to be very careful about how long. You don't want to keep drinking the Kool-Aid and think this is a great company, it's going to last forever. You play until the momentum's running out, and then you move on.
And we're seeing this introduced in a lot of new indexing style ETFs,
yes,
mutual funds, smart beta funds, pure momentum ETFs. I was just on a podcast called Money Tree Podcast Investing.
Congratulations.
They're a top 50 investing podcast, and we were talking about, or the one of the interviewees was the CEO of a company called Crowd Invest. And so they take users' insights, people vote whether they're long or short, positive or bearish, or positive or negative on a particular stocks, and the ones with the most positive votes are indexed into an ETF. That ETF is then sold on the open market. And so literally we're starting to see momentum trading indexed for the first time. And that's a new way that they're introducing, the social media world into how we invest. And so it's something that you have to keep your eyes on more and more, because people are taking it very seriously. They're betting their careers on it, is what I'm getting
at.
Their
life savings, their 401k.
Absolutely. Well, not only those people, I'm saying the CEO. She's starting a company. She's saying, I believe in this. I believe in the crowd that they can provide alpha or extra performance outside of what a traditional equities index fund can do.
Yeah.
And so it's very important that you don't get caught up in momentum, especially short-term momentum, like you just said with the 3D printing.
Right.
So moving on.
Last one is very similar to bandwagon, in-group bias. So here you're looking for confirmation and surrounding yourselves with people that have similar opinions. And worse than that, you're reading articles with similar opinions. You're becoming very myopic. So the in-group bias is you're pretty much not trying to get purposely outside of what you want to believe, what you want to hear.
Right. I love the word myopic, because we have myopic time preferences and values as well that go into investing, and that we're constantly biologically trying to feed the now. We're getting real-time information on the markets. We're getting new information every second, but how do we apply it on the long term? Because we need to put equal value to a future date as we do today. And so when we're constantly bombarded with today is more important than every other date in the future, in fact, the value of the future diminishes as it gets farther and farther away.
Right.
You start to get impacted by these cognitive biases without even realizing it. Now, psychology did a great job outlining this. Law attorneys do a great job outlining these things in the court of law, and now we're starting to see it introduced into economics. And that's why it's very important to think that psychology is creating inefficiencies in the market. Now, in-group biases, are all the people around you, do they all look the same? Do they all dress the same? Do they all like the same things? Is anybody challenging you outside of your comfort zone? If not, we would probably say you need to find some new people in your life to be able to make sure you're well-rounded, well-balanced, that you understand all walks of life and all mentalities and perspectives, so that you can understand that the market, whenever you sell, somebody's buying. Whenever you're buying, somebody is selling, and they disagree with you emphatically.
Right, with their own money.
Exactly.
So tension is what you want to see in in-group bias. You want to see some tension in your life. You want to see some conflict. You want to see some contrary opinions.
To dissipate in-group bias.
And then filter through it, and then there is an answer. There is a strategy that will be more successful for now. And so you need to have that. You don't want to get yourself into an in-group bias where you're reading the same confirmation. If you're reading all the time what you agree with, then you're probably becoming a little too narrow with your research and a little too narrow with what you're doing.
And I think societies hold themselves back. I mean, this doesn't have to go into investing. We could get into a deep philosophical conversation about why did the Dark Ages last for so long?
Right.
Why did we have combustion engines at the Library of Alexandria way before we had anything in the 1800s?
Yep.
So maybe there's some in-group bias there where people are perpetually feeding each other the same information that make you comfortable and don't get you out of your comfort zone. I mean, Da Vinci challenged everybody to the core. And
well, there is.
We need people like
sometimes
that.
it gets bigger than that. Right now in India, if you try and get out of a class structure, caste structure, you can get killed.
Yeah.
So there's a lot of dynamics in play.
80% of India doesn't have a toilet.
Yeah. So it's
crazy.
Yeah. So there's a lot of factors here, but what we want to do is for the listeners is to bring some information to you as to why we see wealthy people, high net worth individuals consistently making more money, and amateurs and lower net worth people consistently not. And you don't want to be part of the people that are making zero returns, or you have some home runs and then you lose it. There's a process, there's a methodology that high net worth and professional advisors do that consistently make money on a more consistent basis. Those players that get to the final 8 at the Poker World Championships are there for a reason.
They're well equipped.
They're not playing with emotion. They're playing with a very distinct, successful methodology that gets them there on a more consistent basis than anybody else.
And we would encourage everybody to take lives into their own hands, to sharpen their tools, to be able to use and build their own fortune, build their own wealth. That way they have the resources to achieve the goals that they want to achieve, to serve others the way they want to serve them, to help others out of the ditch because they got out of the ditch themselves.
Right.
And this is how we do it, by informing each other, by sharing it, by liking, subscribing, and getting the good information out there, sorting out the noise, and bring you exactly what you need, no filler attached. So we appreciate you guys so much. Go to financialtimetraveler.com, share this up, find us on Twitter, find us on Instagram, find us on Facebook. Anton, you're on LinkedIn because you're the man. You have a lot of connections.
Yep.
All right, so thank you so much. And we'll see you on part 2 of Excuse Me, Sir.
Your bias is showing.
There we go. I was waiting for you.
All right,